Hey guys, welcome back to the show. My name is Mike, this is my whiteboard, and today we're going to be talking about two bullish strategies, and we're going to compare and contrast one another and see which might be better for certain environments. I actually had a viewer ask me this question via support email, and he thought it would be a great whiteboard, so here we are a few days later with the whiteboard. So if you've got any ideas or things you want to see that I haven't already covered, shoot me an email at support@doe.com, or you can shoot me a tweet at DoeTraderMike, and I'd be more than happy to create one for you. So today we're going to be looking at the poor man's covered call, which is essentially buying a long call and selling a call against it to reduce our cost basis. And we're going to compare that to a synthetic covered call, which is a newer strategy we've been talking about. Liz and Jenny had this as a part of their synthetic covered strangle that we talked about on the previous whiteboard a few days ago. And we're going to look at these two sort of synthetic strategies to a bullish standard covered call. We're going to see which ones we might use in certain environments. So let's get right into it, and we'll break down the difference of these two strategies. So with a poor man's covered call, basically it's a standard diagonal spread. It's a bullish diagonal spread, and the reason I say it's a diagonal spread is because of the fact that we are combining a calendar spread, which is just using two options on the same strike, but in different expirations, with a vertical spread, which is two different strikes in the same expiration. So when we create a hybrid of that, we've got ourselves a diagonal spread. So in this example, we would be looking at a stock price of 75, and we'd be looking to buy a call in the money. So let's say we looked at the April option, and that was worth $7. And we're looking to reduce our cost basis by $1.70 by selling the February call at the 80 strike. So we've got ourselves a nice diagonal spread here, and it's considered a poor man's covered call because of the fact that instead of buying shares outright at 75, which would take up a lot of capital, we're replacing that with an in-the-money call with a pretty far out expiration date. We're still going to have roughly the same deltas. We're not going to have all 100 of those deltas because the in-the-money call would have to be very, very far in the money to get those deep deltas, but we'll still have a pretty good exposure to the upside if the stock ends up going to the upside. So we've got ourselves a poor man's covered call here, and we're comparing that with a synthetic covered call down here. So a synthetic covered call, or one way you can create a synthetic covered call, is by selling an in-the-money put. So as you can see, we're collecting a pretty large credit, and that's because of the fact that the put is in the money. When a put, or any contract for that matter, is in the money, that means that it has intrinsic value. That means that at expiration, it can be exercised for something. If a put or call is out of the money at expiration, that means that at expiration, there is no intrinsic value. It can't be exercised for anything real. So if I'm looking at a put contract at the 80 strike, and I know the stock price is trading at 75, I know there are 5 points of intrinsic value here. How do I know that? Well, because of the fact that if someone has the ability to sell me their shares at the 80 strike, when the stock price is trading at 75, that's going to have value. For the put owner, this is a good thing because they're able to sell their put for at least $5 at expiration because of the fact that it's going to have that 5 points of intrinsic value. So if someone's buying that option and I'm able to sell that option, I'm going to get a pretty hefty premium for that. And because of that, I'm going to be able to sell it for $6.90. And as you see, since I know I have 5 points of intrinsic value, I can just take the difference of that and determine my extrinsic value. So I've got $1.90 of extrinsic value here, which is why you see my break-even point, which I've got in the orange over there, at 73.10. So there's a reason why I have a simple risk profile graph on this one, but not for the poor man's covered call. And I'm going to dig into this tomorrow. I'm going to be talking about calendar spreads, and it's going to apply the same way to this diagonal spread as we see here. So definitely tune in tomorrow. But to put it simply, we can't really calculate our break-even or max profit because of the fact that our February option is going to expire, and we're going to be left with a long April option. Now, while we can calculate what the intrinsic value might be on this April option over here, or whatever credit we collected in this February option is, we're not going to know the implied volatility levels. It's impossible to determine a future implied volatility level. So if implied volatility spikes up extremely, my April option is going to be worth more than it would be if implied volatility didn't change. So for that reason, it's better off to not calculate the max profit and break even with diagonal and calendar spreads, but we'll get into that more tomorrow. So for this segment, we're going to be looking at the two differences here. So as you can see, they're both bullish to the upside, and they both pretty much aim to get the same exposure. So with the put here, our max profit's going to be $6.90. We're going to be looking for the stock price to come up, but even if the stock price stays the same or anywhere within this range, I'm going to be profitable because of the fact that I know there's $1.90 of extrinsic value here. And again, at expiration, options can be exercised for intrinsic value, or they will be exercised if they're held through expiration for the intrinsic value. So I have the ability to extract $1.90 out of this option if I hold it till expiration, and let's say the stock price doesn't move at all. I'll be able to close this position for $5, and I would be able to reap the benefits of the difference there. Now, one thing I want to point out with a synthetic covered call using an in-the-money put, a lot of people may wonder, well, the put's in the money, so aren't I giving myself exposure to assignment risk? While there is assignment risk with all in-the-money options, you never know what the other party is going to do. For me, I like to consider the extrinsic value in the option. So the more extrinsic value there is, for me, the less chance there is that I believe, at least, that I'm going to be assigned. And that's because of the fact that if someone were to exercise this put, what happens if they exercise the put? Basically, this option contract turns into shares. Whether they're exercising a call or a put, it's going to turn into long shares or short shares. And there's no extrinsic value with shares. So if the owner was going to exercise this option right now, the stock price was at 75 and we're looking at an 80 strike option, they're giving up all of that extrinsic value. That $1.90 or $190 of value, if they were to exercise this option, they would be giving that up. While they would be able to have that $500 worth of profitability in the shares, they're giving up that extra time and volatility value. And for me, I like to measure the extrinsic value of the option and weigh that against my assumption on whether I'll be assigned or not. If this option was only trading for $5.01, then sure, I could be assigned at any second because they're only giving up 1 penny. But since there's $190 in this option, for me, I would believe that I'm pretty safe here. And for that reason, it's not a bad idea to maybe consider a synthetic covered call as opposed to a standard covered call. It's really just using the options strategically to create your own strategies and see what works best for you. So let's go to the next slide here and we'll break these down a little bit further. So when we're looking at a poor man's covered call, as I said, the max profit and break-even point, it's best to just keep that up in the air. So I know for a fact that I have a defined risk max loss on this trade, and that's because I'm routing this order for a debit. Since I know that my April option is going to be worth more than my February option, because there's more time in the April option than there is in February, and because it's in the money, so it's got intrinsic value, I know that my max loss is $5.30. So all I did to calculate that was take the value of my April option for $7 and subtract the credit that I'm getting for selling this February out of the money call for $1.70. So you take 7, subtract $1.70, and you get $5.30. Now let's take a look at the assumptions on this trade. So when I'm routing this trade and I know that implied volatility and the option premium is going to be most in my longer dated option, I'm going to be looking for an IV expansion on this trade. So with that said, I would probably deploy this strategy personally in a low implied volatility environment. You see Liz and Jenny all the time routing calendar spreads and diagonal spreads in lower implied volatility environments for this reason exactly. If implied volatility is super low and we're able to create a directional assumption with a diagonal spread and benefit from an IV expansion, then this might be a better alternative than maybe a standard covered call or a synthetic covered call. Additionally, we've got defined risk. So if there's anyone out there that's uncomfortable with undefined risk, this might be a better option in terms of replacing that same bullish assumption than maybe a synthetic covered call or a regular covered call where the risk is really undefined to that 0 point because we know a stock can't go below 0, but it can go anywhere in between that. But with this option, the most I can possibly lose is that $5.30. So let's go to the next slide and we'll break down the synthetic covered call in the same way. So I know that I collected $6.90. I also know we're looking at the 80 strike on this put here. So I've got 5 points of intrinsic value. So I know that I've got 5 points of intrinsic value that I'm collecting in premium and $1.90 in extrinsic value, which gives me that total options premium of $6.90. So my max profit is $6.90. I'm selling an in-the-money option in this situation, and for max profit to be achieved, I need the stock price to go from 75 to anywhere above 80. It can go to 80.00 or 80.01, regardless of the fact where the stock price ends. As long as it's at 80 or above, this put option at expiration is going to expire worthless, and I'm going to be able to keep that $6.90 credit that I received originally. Now, unlike the previous strategy, I can calculate my break-even and max loss here with this synthetic covered call. So since we're dealing with just one expiration, we don't have that unknown volatility factor, we're looking at $6.90 credit at the 80 strike. So basically all I'm doing is subtracting $6.90 from 80, and I get my break even of 73.10. So at expiration, the stock price can go down to 73.10, and I would be able to buy this option back for exactly the amount I collected. So I've got the 80 strike put. If the stock's at 73.10, at expiration, this would have $6.90 of intrinsic value. And since I collected $6.90, I'd be able to buy it back for the same exact value and break even there. And because I know my break-even is 73.10, and this is just my very first trade, my opening order, it's not a rolling order, I know that my max loss is going to be the same. So since I've got undefined risk to the downside, my max loss is 73.10. So the opposing thing on this strategy is the IV assumption. So for this strategy, I'm looking for an IV contraction. So if we're in a high implied volatility environment, I would probably deploy this strategy over the other, which is looking for an IV expansion. And that's because of the fact that the implied volatility factor here will have to do with the option premium in the extrinsic value of this option. So the higher the implied volatility is, that's implying that options prices are also higher, and I'm going to be able to potentially collect a higher credit. And if IV contracts, I'll be able to buy back that option for a lower price, which would give me profit in the long run. And lastly, this is an undefined risk trade, so for those of you that are looking for defined risk, maybe this one is not the best alternative for you. So let's wrap this all together with some takeaways here. So we know that a poor man's covered call and a synthetic covered call are both bullish assumptions. While they're both bullish, they do have some differences. So with a poor man's covered call, I'm looking for an IV expansion. So I would like this one in a low IV environment. For the synthetic covered call, I'm looking for an IV contraction, so it's just the opposite. I might route this in a high IV environment. The synthetic covered call has undefined risk, although we do know a stock can't go to zero. It can go anywhere in between there, so we don't know exactly where our risk lies or where our max loss would lie, or our loss at any point. We know our max loss can't go below the stock price going to zero. But with a poor man's covered call, we know our max loss at entry. We know that we can't lose more than the debit we paid for that. So our defined risk is going to be with poor man's covered call. And one last thing to note is that the profit and break even are pretty much unknown with the poor man's covered call. We can make some slight calculations, but it's pretty difficult and easier to just leave alone. And with a synthetic covered call, we can easily calculate our profit and break even. So hopefully you liked this analysis. If you've got feedback, shoot me an email at support@doe.com or or you can shoot me a tweet at DoeTraderMike. Thanks so much for tuning in. I appreciate it. We've got shadow traders up next though, so stay tuned.